Thanks for joining us for this timely event with our very special guest, Brian Wesbury. It's great to see so many people logged in this evening, and we will record this for future reference and any friends that miss it. Brian's been kind enough to speak for us before and truly provides the antidote to conventional wisdom. 2020 proved once again that the more things change, the more they stay the same, both with regard to what works and what doesn't work. Who would have thought a year ago we'd be beginning most conversations with, "Have you gotten your vaccine?" The concerns we have today may not be what impacts us tomorrow, and often it's not the bus we see coming that hits us. Our personal vision planning process is designed to take into account the unforeseen and to benefit from short-term volatility. And frankly, volatility is our friend. Short-term volatility gives us the opportunity to rebalance, allows us to generate tax swaps, and may allow us to convert from tax-deferred to tax-free. Now, I've been in the financial services industry since 1986. It's hard to believe it's been 34 years. And clearly a lot's changed with the economy, the investments, and the world. And yet, the keys to successfully building wealth, the mistakes people make, and the fact that ultimately economic fundamentals will play out remain constant. Now, with all the noise today from the internet, the media, and people trying to sell newsletters, it can be hard to see the world really as it is. The media has always played on this, and now, more than ever, so-called news has become politicized and, frankly, in some cases, weaponized. So we may have an exaggerated and overly negative view of the world, which can really create unnecessary fear and stress and may not reflect things as they are. Moreover, when we're operating with the wrong perceptions, it's difficult to develop sound solutions and make good decisions. Over the last 30 years, the two biggest challenges that we've seen for investors have not changed. First one's inflation. The risk that a dollar tomorrow is not going to buy what a dollar today does. When I started, people retired at 65, and they're lucky to live into their early 70s. Today, people retire at 55, and they live forever. Growing assets will have become more important than ever before. The other issue is trying to time the markets, getting out when things are down, and then trying to wait for things to get better. The problem is, when people try to do this, they generally fail. And maybe a chart I have can make this a little clearer. $100,000 invested in January 1st of 2000 in the S&P grew to $324,000, 324, 210 by the end of 2019. If you miss just the 30 best days, your 100,000 shrank to just 67,490. And if you miss just the 60 best days, so really the 3 best days each year, your 100,000 would only be worth 23,310. People get out when things are down, and they try to wait for things to get better. And the problem is, they miss some of the best days. In 2019, 6 of the best days occurred within 2 weeks of the worst days. And the trend was even more pronounced in 2020. Through April 13th of 2020, 5 of those best days occurred within just 1 week of the worst days. So trying to move in and out of the market is disastrous. Now, as mentioned, the volatility, if used properly, can be a good thing. And really, at the end of the day, what the markets do and the portfolio does in the short run really shouldn't matter if it doesn't affect your ability to maintain income. It's kind of like watching a guy with a yo-yo walk up a hill. If you're watching the yo-yo every day, you're missing the progress up the hill. Now, we're pretty optimistic about the near term as stimulus funds enter the economy and states open up. But with a new administration in the White House, concerns about inflation, the border crisis, questions about government spending, the continuing COVID pandemic, and the proposed tax policy by the Biden administration, clearly things are changing. You add in activist investors, digital assets, and markets that seem to hit new highs almost daily, and there's no question why many investors are confused. So to provide some clarity and insight, our guest and my friend, Brian Wesbury, is here. And we have a lot to discuss, so we're going to jump right into it. Some of you know Brian served as the chief economist for the Joint Economic Committee for the U.S. Congress. He's been honored by USA Today as one of the top 10 economic forecasters in the United States and was ranked by the Wall Street Journal as the #1 economic forecaster. Brian's published several books, including my favorite, It's Not As Bad As You Think. And since 2006, Brian's been the chief economist at First Trust Advisors. So, good evening, Brian. Thanks for joining us.
Hey, thank you, Randy. Great to be with you. You scared me when you said we're going to record tonight because I'm about to give some forecast, and you're not supposed to be recorded doing that. You can always deny it later.
Sure.
You know, especially these days with the craziness going on, and so we're going to talk about that. I want to talk about the past year, uh, the things that we have seen happen, and where we're likely to go from here. And we're all glad that 2020 is behind us. It looked like 2021 was going to start out really well, and then we had January 6th to make things crazy, and now we have new variants and all kinds of worries that people have about what's going on in the world. And so I do want to go back to the beginning. Early last year, we started to hear about this virus, COVID-19, running around the earth, and people were starting to get worried about it, but not too worried at first. And then along came late February, early March, and that is when all of a sudden we had experts out there saying we are in a pandemic. Now, never before in history have we done what we have done, and that is shut down not just the U.S. economy, but really the global economy. And if you remember back, I mean, we have Easter coming up this weekend. I remember Easter last year was going to be when it was over. We were going to have 15 days to slow the spread, and everything was going to be fine. But we were going to shut down the economy, have everybody locked down. We ran out of toilet paper. By the way, that's a whole interesting thing. You wonder, how do we run out of toilet paper? And I'm sorry, but this isn't a little aside that I learned along the way. It's amazing how many things you learn during a crisis. But if you think about it, there's toilet paper all over the place. We have it in our home. It's at our offices. It's in hotels. Uh, it's in the restrooms at shopping malls and restaurants. It's all over. And what happened is when we shut down the economy, we no longer went to our offices. We no longer went to restaurants or hotels, and we stayed at home. Well, there turns out that there are two supply chains for restaurants or for toilet paper. One that goes to institutions like restaurants, hotels, office buildings, and the other that goes through the grocery store to us in our homes. Well, when we no longer needed all of that toilet paper in the institutional setting, and we ended up needing more of it at home because we were staying home more, the supply chain that went through the grocery store couldn't keep up. It wasn't a full-blown panic. I guess when we started to find out you couldn't get it, then people panicked about it. But the bottom line, it was because we messed up the supply chains, because they are two different ones. And I think that's kind of fascinating. It's something that I learned during COVID. I'm sure we all learned something. I learned a little bit about toilet paper and supply chains. And so I do really want you to think about what happens when you shut down an economy, because an economy, and I know this sounds like crazy for me to say and tell you, it's a very complex environment, and you can't just turn it off like a light switch and then flip it back on a couple of weeks, even let alone a year later. And one of the ways to think about that is thinking about the supply chains with toilet paper, but everything goes in those supply chains. We buy meat for home. There is meat that goes to restaurants. We last year we were euthanizing chickens because the restaurants weren't buying them. And those chickens, whether they were either egg bearing or not, weren't needed in the restaurant supply chain. We still needed eggs in our grocery stores, and egg prices went through the roof. But the way to think about this, I like to think of the simplest thing I can. So let's imagine a tomato. I mean, what goes into the price of a tomato? Let's say it's 79 cents a pound, and in that price, every penny of that price has an input, whether it's the cost of the fuel for the farmer to get those tomatoes to the grocery store, the cost of the grocery store to put them on the shelf, break down the boxes, and get rid of all of the material that it took to get it there. The farm has to buy fertilizer, it has to fix its tractors, on and on and on and on. There are millions, if not hundreds of millions, of inputs into the price of a tomato. And when you turn off the economy, you will end up with damage to the system. Today, one of the things that we are seeing is that semiconductors, especially for automobiles, are in short supply. And I believe we will continue to hear things like this as we move into the months ahead. One of the inputs into housing costs today is lumber, and lumber prices have tripled because of problems related to production, to shipping, all of the things that COVID has slowed up and created a problem for. And so I believe that if we really think about shutdowns, and early on, and still to this day, I believe that we made a huge mistake with shutting down the economy like we did. And I'll talk about that in a minute when I mention the virus. But I believe that the costs, forget the spending that the government has done and plans to do still, the costs are immense. Nonetheless, we shut down for 2 weeks. Some states opened up reasonably quickly. Some schools opened up in August and started to go back to school. Other places let restaurants start to have 50% of people in, and then they shut down again. I mean, you know all the story of the waves that we have gone through. But let me show you a chart of what the world looks like in the past year, and we can see the issues that shutdowns and opening up have caused. If you look at this, this is personal spending, personal consumption, you and I in the marketplace. The blue line is our spending on goods. All right. The orange line is our spending on services. Now, services would include transportation, airlines, hotels, restaurants, theaters, concert venues, sporting events, all of those kinds of things clearly have been shut down, and we can see the impact. Right now, we're still down massively from where we were before. It's one of the worst declines that I have ever seen in this series. But goods, we're down 5% from a year ago, but spending on goods, we're up 10%. And that's because obviously services have been shut down. Now, I expect these lines to start coming back together as we open up. But you can see that big V shaped bounce in the bottom. And there are a bunch of things going on there. But number one, in the first quarter of last year, our GDP, the overall growth in the economy, was minus 5%. And then in the second quarter, it was literally the worst quarter in U.S. economic history. We fell 33%. Now, remember, that's at an annual rate, but that means the economy shrank about 9% in the quarter, 9%. And so we went minus 5, minus 33. And then we saw COVID numbers drop. Many states opened up, and Florida basically has stayed open since that point. But many states opened up, businesses were allowed to start having customers back, and boom, we had a V shaped bottom. 31% growth in GDP in the third quarter, and then 4% growth in the fourth quarter. So we were minus 5, minus 33, plus 31, plus 4, and that's the V that you see here. But it wasn't even. All right. So today, when we think about GDP, and this is one of the things that I would like you to think about, because it's why I talked about tomatoes and toilet paper, is that yes, goods spending is up. Yes, there are a number of large companies that were able to operate. Without telecommunications, without the new technology, without cell phones, without all of these things that we have invented over the past 20, 30 years. Imagine if we would have shut the economy down 30 years ago. We never could have survived as well as we did. And so what happened is all these big tech firms boomed. I like to think that they had 12 years of growth because we know they would have become more important and bigger in our lives. We had 12 years of growth in 12 months, and they won. In an investing sense, in a stock market sense, in a revenue sense, they won. They boomed over this past year. At the same time, there were a lot of companies like that are large, nationwide, or even international companies, Walmart, Costco, Home Depot, Amazon, who allowed us to get goods, were allowed to stay open, and they won too. However, if you look at that bottom line, you can see it. I mean, what happened to airlines? What happened to cruise ships? What happened to theater companies? They all got crushed. And also in the midst of that, many small businesses got crushed as well. And so while the economy today is only 2% smaller, the overall economy is only 2% smaller than it was a year ago, my belief is that there's a whole section of the economy characterized by that services line that it still has a long way to climb out. There are many businesses that will never come back, and that is absolutely unfortunate. It is one of the costs. I mean, lifetimes into building a business, and it's gone because of these shutdowns. Nonetheless, not only did we open back up, find ways to operate in a COVID environment, use technology more. But we also passed the $2.2 trillion stimulus bill, handed out checks to individuals, handed out PPP loans to businesses, and that fueled an expansion in consumption. It's like borrowing on your credit card to spend today. You can make it look like you're wealthy, when in reality you owe that credit card back, and we will eventually have to pay that debt back. And here we are now rolling into 2021, and the same things are going on. We passed a $900 billion stimulus in December. We just passed another $1.9 trillion stimulus bill this year. $1 trillion of that will be spent in 2021. The rest will be spent in future years. But nonetheless, we're going to see 1.9 trillion in additional spending that would not have happened because we borrowed on the credit card to spend this year. At the same time, states are opening up. Texas got rid of their mask mandate, got rid of all regulations on restaurants and bars, and people that are willing to go back to being normal are doing that. And we see it in the data. back last March and April, we at First Trust, I and my staff, started following what we call high frequency economic data. So this is economic data that comes out on a weekly or even daily basis, and so we're a couple of those items. You can get the revenue for movie theaters on a daily basis. You Open Table, if you've ever used that app to reserve a table at a restaurant, they keep track of how many people are making reservations. The TSA, the people that you have to go through to get to your airplane, they keep a record of how many people come through checkpoints at airports every day. And so when we follow these numbers, there's also rail car traffic, there's steel production, those come out on a weekly basis. And this high frequency data, in my opinion, is a much better way to track how reopenings are affecting economic activity before we get to the monthly or quarterly data, which is often lagged. And so, what all of this data is showing is that opening up, we're seeing more reservations, we're seeing more theater revenue, TSA checkpoints data. Before the crisis, we were seeing 2.5 million people a day go through the airport. At the bottom in early April of 2020, that fell to 80,000 people per day, from 2.5 million down to 80,000. Well, we are now back over the past week, seeing 1.5 million people a day go through. Every one of these high frequency pieces of information that we look at is bouncing strongly. And that's as we open up the economy. We're also seeing the stimulus checks play a role, and we're also seeing people more comfortable with going out. Now, is it correct to be more comfortable? Now, one of the things that I've kind of come to, I guess, realize, I'm old enough to realize a lot of things, but is that there are two different kinds of people. Whether you're talking about politics, whether you're talking about fear and COVID, there are people that will be wearing masks maybe for the rest of their lives, but at least for years to come. There are others who are perfectly willing to go out without a mask on right now, anywhere you ask them to go, whether they've been vaccinated or not. And those people have existed, both kinds of people have existed all during this last year. But right now we have hope for everyone. If you look at the data on the path to herd immunity, I want to explain this chart a little bit. The every bar on this chart is a week since last year. All right, or excuse me, it's a day since December. The dark blue line is the number of people who have had COVID, and and we are believing, and the CDC believes, that people who have had COVID have an immunity to it, at least some kind of immunity. Now, the CDC also estimates that for every person that has had COVID, there are 4 people that also had it that we didn't find, all right, that we didn't test. And so that's the orange part of this line. And then on top of that is the gray bar, which is vaccines. In the past month, we've put 50 million shots in people's arms. And when you add all of these up, because technically, if you've had 1 shot, 2 shots, or you've had COVID, you have some immunity to COVID. And we are now at the 70% mark of those 3 things combined for the United States as a whole. Let me give you another statistic. People 70 or 65 years old and over in the United States, as of today, 73.1% of those people have had at least 1 shot. All right, 73% of people 65 and over in the United States. And just for reference, people 65 and over in the US, they represent 16% of the population, but they represent 80% of all the deaths from COVID. And so what we have done is we've reached herd immunity levels of vaccines, let alone people who have had COVID on top of it, but just the vaccines in the 65 plus category. And so when you realize that kids have a 99.9% chance, a better chance of surviving COVID than they do of the flu, and you realize that the people at most risk, 80% of all deaths, people 65 and over, have received at least one shot of the vaccine, you realize how close we are to opening up the economy. For the life of me, we've been following this data as closely as anybody. For the life of me, I do not understand how the CDC director can give a speech where that she says she has a feeling of impending doom. If that is really true, all right, I want you to think about this for a second, because it bowls me over, and that is, if we have 73% of the people over 65 inoculated or at least vaccinated part way, if we have had COVID run through the system as much as it already has, and yet we're still worried about the future, then I mean, I don't even know what to say. They told us 15 days. They've told us till we get a vaccine, and now we're supposed to believe, even though we have a massive amount of vaccines going into people's arms out there, that we're facing impending doom. If that's really the case, we'll never get rid of this ever, because having COVID doesn't protect you, getting a vaccine doesn't protect you, and so the bottom line is either you believe that we are at the end or you don't. And if we're not at the end, even after vaccines and having the disease spread as much as it has, then we'll never be at the end, ever. There is no, if it really is true that we're facing impending doom, then vaccines don't really work. Now, I don't believe that. I think the vaccine does give you an ability to produce the antibodies. I think having COVID teaches your body how to fight this off as well. That's how we fight off all kinds of things with our bodies. Our bodies learn how to produce the antibodies. And so the bottom line is that this year we are going to reach herd immunity. The disease is going to go away. And it goes back to something I've been talking about for the past year. You can look it up if you want, but there was a doctor in the 1800s who came up, his last name was Farr, Farr, came up with Farr's law. And what he said is viruses follow a bell-shaped curve. They hit a peak, and then they go down the other side, and then we don't hear from them again. And that's the way viruses have behaved the entire history of the human race. And there's no reason to believe that this one is any different. What is different is that you can hide from it. If you locked yourself in a house and had only people deliver you food and toilet paper, and you sprayed everything down and disinfected everything that you touched and wore gloves and a new mask every time you used one, you could technically hide from it. If we do socially distance, we can slow down its transmission, but it doesn't go away. And we see this over and over again. When countries open back up, the virus comes back because it never went away. We never let it go through the population. Well, we're lucky this time. We had a vaccine in a year. That's never ever happened before. It is a miracle of modern technology and the ability to get rid of bureaucracy. And that's for a lot of people, that's the only thing that's going to let them get back to normal. But viruses have been around the human race forever. They follow Farr's law, and all we've done is kind of interrupt it and slow it down, but not make it go away. And I guess we're lucky enough to have a vaccine now, because if we didn't have one, I'm assuming that people would still be talking about lockdowns, and that would be a disaster for our economy. Now, speaking of disasters, and I don't want to scare you too much, but I want you to look at this chart, because this has been our response. We have boosted government spending. This is our federal government spending, non-defense. All right, I took out the wars. and defense spending, and just looked at non-defense government spending as a share of our economy. All right. So if you go back to the 1930s, we had a massive increase in the size of government. That was during the Great Depression. We built the Hoover Dam, the Tennessee Valley Authority. We put all the roads in national parks. We also created Social Security and created a welfare system that we didn't have before, and government spending went up dramatically. It also happened in the late 40s and early 50s with the GI Bill. Government spending went up dramatically. And then you can see from 1960 to 1980, this was the Great Society, Lyndon Johnson. This is when we put in Medicare, Medicaid, expanded Social Security, created really the modern day welfare system. And so what we're looking at there is a large increase in government during that entire period. We then flattened out for a long time. And if you look at the spending that we have today, it is a massive jump in government spending. The question is, how do we pay this back? And there are a couple of I know this chart scares some people out there when they look at it, but I do want you to think about one kind of comparison, if you will. We spent this much just to fight World War II. So I told you I took defense out of this chart. We ran up massive debts. We went way over 100% of the size of the economy in our debt in America, and yet we ended up basically climbing out of that hole, paying that debt off, making it so small relative to the economy that it didn't matter anymore. And we eventually balanced the budget in the late 1990s, early 2000s. How did we do that? Well, one of the reasons we were able to do that is that after World War II, the United States, we weren't bombed. Japan was bombed to smithereens, obviously, with nuclear bombs at the end. Germany, all of Europe was bombed. The Germans either bombed the UK or France, and we bombed their side back. Cities were destroyed, and the United States basically took the technology we use to manufacture so many tanks and airplanes and guns and jeeps and bullets that we won the war, and we translated that into producing goods for the consumer, whether it be washing machines or automobiles, and we were able to sell a lot of that overseas. And what happened is that increase in productivity, that increase in the industrial base of the United States let us pay it off. So what's gonna get us out of this today? Well, here's just a thought, all right? And that is that we, like I said, saw 12 years of growth in technology in 12 months. We're not going to give that up. Obviously, we're not going to have as many Zoom meetings in the future. But the bottom line is that we've seen people accept technology. They already accepted it, but they accepted it in their lives way more than they ever did. We've made advancements with apps. Everybody here, everybody on this with us tonight has been to Chick-fil-A or McDonald's, and you use your app and it says, I'm in parking spot 2, bring me out my food. None of that existed prior to 12 months ago. Now we've done all of that. We've increased our productivity because of this technology. And then when you add on to that, the fact that we're getting 5G, which is going to make all this technology work so much faster. I don't know how much you've watched this, and unfortunately you can't invest in it because it's a private company. But Elon Musk, through SpaceX, that's his space company, it has a subsidiary called Starlink. And Starlink is putting up thousands and thousands of satellites in low orbit. And those are going to give you high-speed internet anywhere you are in the world, which, by the way, is 8 to 10 times faster than my home cable-based. I'm a Comcast customer, cable-based system. It's going to be way faster, way more reliable, and these satellites are going to be in every inch of the earth, cover every inch of the earth. And so while cell phone technology took communications around the world. This is going to take computer power around the world like never before. We also have blockchain, which is part of the cryptocurrency Bitcoin world. It's a whole new technology, the cloud. All of these things are going to increase our computer capacity, increase our productivity in the future. And in my view, that's the only way that we climb out of the hole of the debt and the money that we are spending. Good news is, at least from an investor's point of view, I don't think we have to worry about any of this right now. 2021 is setting up to be a massive year of growth. On this Friday, 2 days from now, we will have an employment report that is somewhere around 600,000 or 700,000 jobs for the month of March. We expect million job months in the remainder of this year. And we think at the end of this year, we will be under 5% unemployment. We will have created 6 million jobs, which would be an all-time record for the United States. But remember, all we're doing is digging out of the hole that we built. Now, if you look forward, one of the things that is going on, and one of the reasons the economy is growing, is that the Federal Reserve has printed a lot of money. They've used some of this money in fact, quite a bit of it, to finance government spending. And as a result, the money supply is now up 27% over the past year. There are a lot of people at the Fed, a lot of investment analysts and economists who believe that this will not turn into inflation. And I'm going to tell you, I'm not one of them. If you look back over this past year, housing prices are up somewhere between 10 and 12%. We have a bunch of different measures of that. We have oil over $60 a barrel, gold up over $1,700 an ounce, lumber at an all-time record high, corn, wheat, soybeans, all of these things are going up. And my belief is that this increase in the money supply is going to lead to inflation. I guess the good news from this as an investor is that first, this money boosts economic activity. And so Milton Friedman, one of my favorite historical economists my favorite of all time, said that when the Fed prints money, for 6 months to a year to 18 months, you get more growth in the economy as a result. It truly is like a sugar high. But then eventually the sugar goes away and it turns into inflation. So my view is that we will have inflation. Now, some people are saying, "Hey, what are you talking about? If you look back at inflation, look at this chart. We might have hit 2.5%, 3%, and right now we're at 1.7% over last year. So what inflation are you talking about?" Well, here's the problem looking at year over year inflation, and that is if the next 2 months of consumer prices are up only 0.2 per month, that's what this looks like. We will end up with over 3% inflation in the past year, and my view is that it is moving higher still in the years ahead. So I do believe that investors need to protect themselves against inflation. The ways to do that is to own commodities. I would not go out and just buy gold or just buy silver or just buy oil. I want to own a basket of them. And by the way, owning commodity producing companies is actually an interesting way to play this inflationary pressure, because you could own a ton of copper. All right, technically. I don't know where I would put it, but I could own it. But wouldn't I rather own a company that made 10,000 tons of copper every week? And so that if the price of a ton of copper goes up, they're going to make 10,000 times that. And so if I invest in what we call materials companies, I can also get exposure to inflation. At the same time, small businesses, small cap stocks tend to do well in inflation, and so do industrials. If you think about it, if I own a $400 million machine that I bought a year and a half ago, but I'm going, and that's technically using non-inflated dollars, and I'm going to sell the things that machine makes today at inflated prices, I can see expanded profit margins. So this is not a reason to run away from the stock market, but it does influence us in where we might go in terms of that. And so I think inflation is coming. It's going to take a number of years for it to play out. My final couple of comments here. Just talked about a few sectors of the market that I like, but let me just tell you that I still believe the stock market will finish this year very strong. It is undervalued. Profits have exploded upward. In fact, in 2021, corporate profits are going to hit a record high. Interest rates are still low. The Fed does not plan on raising interest rates for a number of years. I still think the pressure is going to be on for them to raise rates, but they're going to refuse at least this year and probably next year as well. And so when you have rising profits but low interest rates, what ends up happening is the stock market has only one way to go, and that is higher. I do not think we're in a bubble today at all. I believe this next 12, 18, 24 months are going to be very, very good for equities. Now, eventually, we will have higher taxes. The debt that the spending that we have done and not paid for with tax dollars today is going to have to be paid back, and all of that will end up creating problems for us down the road. I can't tell you exactly when that will be, but what I do believe is that over this next year, we are in really good shape for the stock market. The economy is going to explode. The Federal Reserve is printing money like crazy. The government is spending money, whether we like it or not, like crazy. The vaccine is rolling out. We are reaching herd immunity. And when you put all of that together, it's an explosive year for economic growth in the United States. A weird year, one that we will have to pay for in the years ahead, but one that investors have already benefited from, and my belief is can continue to benefit from as 2021 unfolds and 2022 starts. So, Randy, thank you very much, and I'd love to see if I didn't cover anything, or you have anything you want to ask me.
Well, again, today, the Biden administration talked about their so-called infrastructure bill, but buried in that was a lot of talk about increasing taxes. And there's been a lot more discussion of the tax plan, which essentially raises taxes on corporations, whether it's to 25, 28, or 35, raises taxes on capital gains, and kind of a myriad of other things. So what do you think might get passed, and what do you think is the impact on the broader markets or investors should look at?
Yeah, these are all obviously these are important and great questions, Randy. It now looks like the Biden administration's plan. I'm not sure. I'm sure they have to do this for political reasons, but their plan is to divide their stimulus bill into two segments, and they've kind of carved out infrastructure and some of their environmental spending in the first section, and then they're talking about social plans in their second one. And as a result, what they're talking about now, they're going to do both. They want to do both of these this year. Is that they're going to try and pay for the first one with more of the corporate taxes. So they have mentioned that they want to raise the corporate tax rate from 21%, where it is today, back up to 28%, and that's going to be part of this first bill. Now we also know. Now let me just go back. This first bill is $2.25 trillion. And if you raise the corporate tax rate from 21 to 28%, the most you're going to be able to raise is about maybe in the best profit year ever, about $100 billion extra in tax revenue. It's not even remotely close to paying for this bill, but at least they get to say we're raising taxes to help pay for it. And they may even say pay for it, but it won't pay for it. The second set of increases will be more on the individual, and I think this is why they want to separate these two bills. So the next one will be more about the social world we live in. justice, equality, all of those. And that's where they want to tax the rich. And so they will, and I put that in quotes. And that's where we will see a 39.6% top marginal rate. We will see the rate on right now, the rate long-term rate on capital gains and dividends is 23.4. I expect that to go up to 28 or 29%. That won't, you know, the most of the money in the United States. I fully understand that the richest people are at the top. But if you look at where the biggest chunk of income is, it's in the middle. All right. And if they don't raise tax rates on the middle class, they will not be able to raise enough at 39.6 to even come close to offsetting this spending. But nonetheless, we will end up raising tax rates. My view is that higher tax rates do slow the economy. They create less savings, less investment, less work effort. However, when we look back at history, remember when Trump came in, the corporate tax rate was 35%. Now we're talking about going back to 28. Under President Obama, under President Clinton, the top tax rate was 39.6. So we're talking about putting it back there. The capital gains rate was even higher under if we go back under George Bush, H.W. Bush and Bill Clinton than it is today. And so the result is that we've been able to create wealth and see the stock market go up, even with these tax rates that they are talking about. I'm putting them in context and just saying there is no way they will be able to pay for all this spending with the tax rate numbers that we are seeing right now. That doesn't mean I expect them to be much higher. I don't think they can be. I think they would lose. You can only lose one vote. You can't lose any votes if you're the Democrats in the Senate. And if you try to push tax rates above those levels that I mentioned, I think they will end up losing votes. They also, by the way, want to do a mileage tax, but there's states are just too different. I mean, if you live in Montana, you're automatically driving more than if you live in a city. It's just, and I fully get it. People have kids in soccer and they're doing 1,000 miles a week, but try going, driving 6 hours to go to your bank because you're a farmer in Montana, and you have a mileage tax. It's just not going to fly. I don't think they can get 50 votes for that. So, there is a line that we can't cross, and I think with taxes we aren't going to cross that line. Thanks, Randy.
Well, along those lines, everyone talks about they try not to say redistribution, but frankly they are. On a global scale, the Davos Initiative talked about this reset, and I think there's been a lot of confusion about the so-called Great Reset.
Right.
To put the world economy on kind of a sustainable path.
Right.
Path. So what are your thoughts? Is this hype? Is there anything to it? What should people be looking at?
Yeah, so people do get worried about the Great Reset, and if you go on the internet or if you have friends on Twitter, you hear a lot of horror stories about it. By the way, the Davos, which is and I'm sure the people who know what we're talking about on this don't need this explanation, but just to explain it, it's a town in Switzerland, a ski resort in Switzerland, and every year the most wealthiest, most powerful people on the face of the earth gather. So this would be Bill Gates and George Soros and literally presidents of lots of countries, treasury secretaries. They gather and they have big think meetings and talk about stuff. And lately they did call it the Great Reset. And what happened is they lost the marketing campaign on this. And so now they're starting to call it the Davos Manifesto, which I think is a bad marketing as well, because when you call something a manifesto, it doesn't sound very freedom-ish to me. And so what I would argue, Randy, is that for a long, long time in the world, socialism versus capitalism has been the battle. It's technically, I guess, the battle all the time in the United States. I'm not saying Republicans are capitalists and Democrats are socialists, but it's always about redistribution versus less redistribution. So what who controls the redistribution of wealth? And I would look at Davos as really no different. They don't have any voting authority in the US. They may want certain things, and they may try to use corporations to get some of those things, but in the end, corporations, if they aren't focused on profits, their stocks don't go up. And so the bottom line is, I get it. There are a lot of people today that want a world with more redistribution, a more socialist world. But I don't think America is ready to go that way yet. I guess we've gone further than I ever thought we might. But my conversation about tax rates just a minute ago, it ought to show us that even in this world today, the Democrats can't get enough votes to jack tax rates up to 70% again, like they were back in the 50s and 60s. And so, we have reached this point where you can't take the United States as far left, if you will, politically, as a lot of people think. I know we've gone farther than a lot of people wished, but the amazing thing is the power of capitalism, and especially today's technology, allow us to create a lot of wealth, even with a government this big.
So, pivoting on that thought, talking about technology, digital wealth, and assets, what are your thoughts, not just on, say, Bitcoin, but on the NFTs and crypto in general? Do you kind of view that as a investment? Certainly Bitcoin is not a trading currency, and more recently, it's kind of moved lockstep with the market. You're not seeing
Right.
inverse relationship that some people would
Right.
talk about. One that, personally I understand, but just baffles me are the NFTs, the non-fungible tokens, where Jack Dorsey's tweet sells for a couple $1,000,000, or a
Right.
digital piece of art sells for 60 million. But any thoughts on kind of that aspect of the digital world and as an asset class?
Yeah, I'm going to try and go short on this because we could go all night on just this stuff. But uh, let me talk about Well, let me talk about Bitcoin first, and then go to NFTs. But there are two ways to think about Bitcoin. One, and there are many people who believe this, think that Bitcoin is going to replace the dollar, that it will be the currency of our future. Now, I got to tell you that if this were really true, I'd be happy. I'd be excited. I'm gonna, for example, I will take at face value and I will believe it lock, stock, and barrel. I Part of me wonders that the guy who invented Bitcoin and wrote the code, the algorithm that let people mine it, really did limit the number of Bitcoin that could be in the world to 21 million. All right. And if you think about that, that's a really good money, because the government, it's what we call in economics hard money. It's like the gold standard, except even harder, because we find a little bit of gold every year. If you can only have 21 million, you can't print anymore. So that chart I showed everybody of the money supply, the Fed couldn't do that. Now, here's one of the things to think about. If the Fed can't print new dollars and buy the Treasury's debt, which is what we've been doing, if we live on a Bitcoin world and the Fed says, well, the Treasury may want to issue bonds, but we can't buy them, we can't make any more Bitcoin, then the Treasury would have had to go to the private marketplace to sell those bonds. And I believe at that point interest rates would have shot up. But because the Federal Reserve can buy them, they can keep interest rates from going up for a while. Eventually, you can't do this anymore. That's why we get inflation. We've tried this stuff in history and it doesn't work. But Bitcoin, if we would have had a Bitcoin world, there is no way the government could have spent an extra $5 trillion in the last year. No way, no how, because they would have had to buy it all. They couldn't have printed the money to help them pay for it. So that's kind of an interesting thing to think about. And when I think that through that way, the government will never let Bitcoin be the money. Now, having said that, Bitcoin is a platform for transferring information, and it's built on a thing called blockchain, and blockchain's here to stay. I mean, there are places already where a calf is born, a calf, and then we assign it a digit. We know everything it ate, every other cow it came in contact with. We're putting and this, if we're worried about mad cow, now we know exactly where that cow was. We're putting home titles on blockchain because they're unbreakable. We're now starting to put medical records on blockchain because they're unbreakable. And so the bottom line is this is a really great technology for transferring information, and you might even be able to replace all the wire transfers and all the checks and all of those things, but you can still use a dollar over it. If they create a digital dollar, that's what we'll use. I just don't see Bitcoin as becoming the next currency. I'm not saying it won't go up a lot higher than it is, but I'm really worried that eventually someday it ends at zero because the Federal Reserve puts their own digital dollar in. Now, if you talk to the millennials, they'll tell you, man, you're an old guy, you don't understand. And they're all into these non-fungible tokens, which, by the way, they're the same algorithm, sort of. Like, all the algorithms are a little bit different, but they're the same thing as the Bitcoin. It's just for a different kind of coin, and they use them for different things. So people buying a tweet. It's a digital asset. It's just a tweet, and you get the exclusive right to it. And they pay crazy amounts of money for this. And the way to think of it is, it's sort of like a baseball card. And for example, one of LeBron James's dunks, you can own the video of that dunk, or Michael Jordan's dunk. You can own the video of that, the exclusive digital rights to that video. Now, here's the thing. If you spend $250,000, and I fully understand people have spent 30, 40, 50, 60 million on things, but let's say you spend $250,000, keep it in the numbers that I can, comprehend, for a Michael Jordan dunk. And it's a really great dunk. Well, guess what? How many dunks did he make in his career, first of all? Second of all, how are you ever going to make your money back? Somebody might, maybe, buy that, the video rights to that dunk to put in their documentary or their little clip about basketball during the Olympics, and whatever. But the bottom line is you're not going to make your $250,000 back. And so some of these prices that people are paying for things like a tweet, that's just a collector's item, and to me, it's not worth that. Maybe it's worth that to you, but I don't know what you get out of it. You don't get anything. And there's a lot of people that think that about a baseball card or a football card, and it's only worth what somebody else will pay you. Now, let me just bring up one other thing. This is fascinating to me. Remember those old video games that you and I played, Randy? Pac-Man and Pong. What if you could buy the right to Pac-Man, the digital rights to owning Pac-Man, and own it? Well, now you own a franchise, and you could actually make money by having people play it online. So I could see a revenue stream from things like that. So we're early in this. I can't think of it all the way through. Somebody clearly has, but I don't see how you get $250,000 back out of a clip of LeBron James dunk, because there's 10,000 of them out there, and why yours is special and theirs isn't, I don't get. So I think, I don't like this space that much. I think blockchain's here to stay. And but I just don't think Bitcoin's going to become a currency, and I think they have a lot of work to do before NFTs become truly valuable.
Well, and I think, people use the analogy of a baseball card. There is a physical card. There's a limited number. You have a tweet.
Yep.
You can make as many copies as you want. And so,
right.
Like you said, something's worth what someone will pay for it. It's kind of the fungible
Yeah.
value. So, the other
What
thing,
they'll say, what they'll say, Randy, is that the blockchain, it assigns a unique identifying code to
right,
that tweet. So you can make a picture of one, but it doesn't have that. It's sort of like, you buy a Michael Jordan autograph, and then on the back of it, it's got the certificate that says this is real, and you have to trust whoever is there. But with this, you don't even have to worry about trust. Artwork is there's all kinds of fakes and forgeries out there. So that's what they're trying to say, is that this avoids that who owns this, because this blockchain is unique and it can't be stolen, and it can only be transferred and held by the owner.
and kind of our point of view, I think, obviously the NFTs run on the Ethereum platform. But when you look at blockchain or any of these things, when there's a gold rush, you can be a miner or you can be the guy selling the picks and shovels. And I think
Right.
the argument is, the picks and shovels guys are the blockchain guys, the tech guys. It's certainly the better way to
Right.
to go. Which
Yep.
actually leads me to a question. Um,
Go ahead.
Mark Twain said, "It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so." So, risk, when there's very high degree of confidence in something among market participants, whoever it is, and then obviously the outcome doesn't happen. So I guess, what do you feel the pundits have absolutely wrong today?
Yeah, I mean, I'm going to reverse that just a little bit, Randy, and just say, what keeps me up at night? What is it that could wreck my forecast for this year? And I guess it goes back to what I was talking about with um, kind of new variants of COVID, and the impending doom that the CDC is talking about, because for I don't understand it completely. I have to tell you, but there are people that would be willing to lock down. And maybe if you keep getting paid and you can do your work remotely, and you're not, your business hasn't been ruined, and you don't have kids that aren't getting taught in school, and maybe for those people they can't. It doesn't seem to me like there's that many people like that out there. At least it's not a majority. And so I just can't imagine shutting down our economy again. But if we did, it, yeah, forget my forecast. I think what we would see is what worse than what happened at the beginning of March and April of last year. So that's my biggest fear. The other fear that I have is that, and unfortunately we just don't know. Is how much of the growth in the economy and in corporate profits in the third quarter of last year, the fourth quarter of last year, and then what we expect for this year, which is booming economic growth, how much of that is due directly to spending on the credit card? And because if you spend an extra $10,000 last year on your credit card, and then you spend an extra $10,000 this year, there's no growth, right? You made your income, you borrowed 10,000, and then you spent the same amount in both years. You have to keep spending more to have growth. And so what we're seeing is that, at least right now, spending went up last year, it's going up this year, and then the question is, what about next year? If we don't pass another, 0.9 and 1.9 stimulus bill, then we're going to end up spending less in 2022, 2023, 2024. And that will flow through the system. Unless the private sector can make up for that drop, we could have a contraction, a recession in the economy. The other thing I worry about is inflation. I think for right now, Inflation is going to likely be 3% this year, probably 4% next year, and that's not going to bother too many people. But if it gets above 4% and starts to rise, the Fed will react by lifting interest rates, and that's going to knock the market down as well. So, my view is that vaccines do work, and if they don't, we just have to throw up our hands and go back to life. Throw our hands in the air and go back to life as we knew it anyway. But nonetheless, I'm not in charge. And if we shut down, slow down spending in the years ahead, or we end up with too much inflation, those things are the risks that I worry about. The final point I make about that is that the shutdown, I guess, could affect us this year. I do not see that happening. The rest of the stuff, inflation and a potential problem with government spending, that happens in the future years. So for right now, I think we're pretty safe as investors owning equities in the United States.
Yeah, and I think you need to make the money while you can, certainly. But
Yep.
I think, another point, not necessarily specifically with shutdowns, but politically, if anybody shuts stuff down, that's going to be politically tough going into an election year in 2022. Yep. I think
Totally.
kind of put some rails on it. The other thing, of course, would be stagflation down the road. But that being said, if we look at investors, not speculators, because God love them, they're on their own, but investors, is there any kind of final thoughts what you feel they should be looking for, thinking about, kind of those signs? When I kind of look at the Fed kind of like traffic lights. The Fed, it signals. When they say something, if it's green, you go, stop at each intersection, check traffic. If it's red, you stop. So what should people be looking for beyond the noise and the politicians as investors?
Right. Yeah, let me take off on that just real quick. All this Reddit stuff, GameStop and all these crazy stocks that were going and the short sellers and all of that. And then last week it was this big hedge fund and Goldman Sachs and other big banks are selling, $10 billion worth of stuff. Well, I actually, as an investor, I want everybody to step back and go, okay, these are all big news. They're all over the TV. If I'm watching Fox Business or CNBC, heck, even if I'm just watching regular news, you see it everywhere. Like they keep talking about it. But these are individual stocks, and if you own a broadly diversified portfolio, you don't have to worry about any of them, any of this stuff. It's just noise. And so, as an investor, I want to be I want to be diversified. I don't want to buy stocks that are expensive. I want to buy stocks that are cheaper than those stocks. And so if you pay attention to how you're building portfolios, how you're selecting stocks, and that's why you're there, Randy. I'm putting it back on you. You don't have to worry about all this noise. It's just noise, okay? But then the other thing is that when the Fed says they don't have to worry about inflation, the old line used to be, when the Fed's not worried about inflation, you should be, all right? But at the same time, I'll put an addendum on there. When the Fed's not worried about inflation, they're not going to get tight. They're not going to raise interest rates. They're not going to shrink the money supply. And so right now, it's like it's green lights. I mean, I'm almost scared to say it because you put the stimulus in, you put the easy Fed in, you put the opening up trade because of the vaccines and herd immunity. You put all of that together, and it's an explosion in corporate profits and economic growth. We think the economy is going to grow 6% this year, one of the fastest growth rates ever in history. Got to go right after World War II to find anything like it. On any kind of basis at all. And then we're going to create 6 million jobs, which is an all-time record in U.S. history. And profits are going to go to record highs. And so as investors, yes, there are going to be warning signs out there when the Fed starts to raise interest rates, when government spending starts to taper off. But for right now, I they're not going to happen. And so, my belief is as an, here's the, I'll finish with this. I think we're close there, Randy. But if the umpires, were opening day is this weekend, so baseball's coming. But if the umpires start the baseball game and they grab the two teams and they say, "Hey, we just want you to know that in the seventh inning of today's game, home runs are going to start to count for two." All right, but not up through the first six innings, only after the seventh. So how do you play the first six innings? Well, you play it normal. You bring the team that brought you there, you bring the team you got, and you play baseball the way you're supposed to. Then in the seventh inning, now you change your strategy because home runs are worth two. So for right now, we're in that. I don't mean this like, don't take the time context too strong, but we're in that first six innings. We're the Fed's easy, herd immunity's coming, government spending's massive. We're opening up the economy. That we invest. Then later on, does the Fed going to raise rates? How higher taxes going? Is government spending going to slow down? Do we have to pay back more debt? Those are the things that start to matter then, but they're not in play for this year.
Cool. Well, I appreciate it, Brian. I would say to everyone that's listening, if you have questions about this evening, or we can otherwise be of service, just reach out to us. Our office is open. We actually never close. We are following the CDC guidelines to protect you. We're happy to meet virtually or in person if you wish to do so. I've done this 34 years, and we've weathered a lot of storms. But our focus has always been on looking beyond the noise and just looking at the well-being of our clients and our team and our community. So to do this, we continue to evolve. The new technology we're using to monitor and rebalance, I think, is a good example of that. So with that, our team would like to thank all of you. I would like to thank our team. And first and foremost, I'd like to thank both First Trust Advisors and Brian for joining us. There's always been uncertainty about the future, and there's often concerns about the present. There's always reasons not to invest, and yet today, if you listen about inflation, people living longer, I think the need to invest properly is greater than ever. And so, the reality is we don't know what we don't know, but with our process, it just doesn't matter. So regardless of what transpires, we're here for you. We appreciate the chance to share your journey. As always, your vision is our priority. So thank you, and have a good evening.